What happened? Why did SUV you think collapsed?
See, typically, any lending company or an organization typically go down because the asset book doesn't do well. Because probably they have done bad loans, they're not able to recover the money, and hence there is a big liquidity issue, and hence the banks go down. Whether if you look at globally, that's how lending organizations have come down. But largely the reason is your asset book is not doing well. And that is typically because of probably the leadership has taken the wrong decisions on where to deploy the asset. In case of interestingly Silicon Valley Bank, their asset book actually was extremely of good quality, right? The issue was on the liability side and the treasury side.
Why did SVB or Silicon Valley Bank collapse and how to protect yourself against market crash? Let's discuss all of this and much more with the largest venture debt fund in India. We are talking to Ankit Agarwal, managing partner of Alteria Capital, which has assets worth almost $500 million today. Now, Ankit is an industry veteran and has backed Boat and Aman Gupta in his early days. And he's very bullish about consumer brands ever since. We talk about building brands, building companies, and building funds. Don't miss this episode. We discuss almost every mistake that companies make, and especially so in a market downturn. This episode is like a masterclass on all the to-dos for building a business and a startup in general. Watch it till the end. But also one last bit, it would mean a lot if you subscribe to Goventure channel at this point. Hey Ankit, welcome to the podcast.
Thank you, Pritesh. Thanks for having me.
So Ankit, मैं start करना चाहता हूँ with the probably the evergreen question कि why do so many startups fail? Why do you think so many startups fail, man?
It's an interesting question to start with. There, I think startups fail because inherently the idea of starting a venture, right, is typically you're not continuing with the legacy of what your forefathers built and you're taking this forward, right? You're starting a venture with a new idea where most likely you haven't actually done business in that zone, right? You're trying to create a business model. You're trying to almost sometimes create an industry, right? And in that case, you're starting with a risk reward framework where you typically get people together who are backing you both in form of capital as well as the team members who join you, right? And you're taking on a problem and trying to solve an extremely big problem. And naturally in that course you don't have all the variables in front of you when you start, and the variables are not known. As you move forward, there are innumerable number of challenges that you have, both it could be sometimes in form of regulation, sometimes in form of finding the right team, sometimes in form of competition, sometimes the market is not ready for it. We have seen so many startups fail because the market is probably not ready for that startup idea, right? And naturally when you are kind of taking on such a big problem, there could be innumerable number of variables that come into the play, which typically doesn't let a startup move forward, right? And in that case, even if 30-40% of the variables are not moving in your favor, right? You're fighting against odds all the time. And naturally, startups don't have that much strong build-up base of years and years of business and experience that that keeps you going, compared to a traditional company where even traditional company goes through a lot of shocks. But startups don't have that typically solid base of vintage of years on doing business, which typically at some point, founders rightly call it off that, hey, let's try to solve a different problem. I know it doesn't work out, but essentially you're trying to disrupt industry. You're trying to create a business model which doesn't exist. Naturally there'll be too many things that you have not predicted, hence a lot of things don't work out your way.
Got it. And before we get to the before we get to more deeper into the venture debt ecosystem and how it is supporting startups and all of that, I want to understand who are the people behind. We understand that the world knows the people behind, say, फाउंडर्स बिहाइंड स्टार्टअप्स, जो शार्क टैंक ने बहुत फेमस करा एंड ऑल ऑफ दैट, एंड अब बहुत सारे लोगों को स्टार्टअप्स का पता चल गया, बट हु आर द पीपल बिहाइंड द फंड्स, who ये वेंचर कैपिटलिस्ट, एंजल इन्वेस्टर्स, वेंचर डेट फंड्स, who are these people?
See again, a very relevant question, because यार काफ़ी बार हम बात करते हैं कि यार अल्टीमेटली एवरीथिंग दैट अ स्टार्टअप इज, either it succeeds or a fail, largely founder comes in front, right? It's essentially like any movie that you talk about. Typically, the protagonist of a movie is either complimented or blamed for whether that movie is successful or not. But you know, the directors, the producers, the crew behind the movie is not really spoken about. In the case of a startup, typically you can call the production house or the finance crew behind the startup essentially is the VCs or the investors in this case. And the good part is VCs actually come from all different very backgrounds. Essentially, there are people who have seen startups either being on the operating side of running a startup or a business themselves, or have years and years of experience of funding startups and go through various cycles of what has worked, what has not worked. And most importantly, it's important to understand that in a startup, the risk and reward framework is always shared. Hence, you're also able to see so many number of venture capital investors and startup founders coming and together joining that ride together. Because we believe that this ride is kind of taken forward together on day one, both by investors as well as by the founding team, where investors understand that their responsibility is to get the best capital from their own investors, what we call as limited partners or LPs, to ensure that they find the best idea, best founders, where they can deploy that capital that they have raised from the investors to get the best return for their own investors. Now that's a long journey. It typically takes 7 to 10 years for you to know whether your investment has actually worked or not for a venture capital equity investment. It's slightly different for the venture debt investment, but largely for equity investment, it's a long haul journey. So like it's a long haul journey for a founder, it's also a long haul journey for the fund manager, where if you're investing into a listed equity fund, right, you'll probably know in 6 months to few years that whether your investment is working or not in form of returns. But if you look at private venture capital investments, it is a long haul journey for the fund manager as well, where they are getting commitment of capital for very long term from their own investors, and they need to be in the journey for at least a decade to see whether their investment that they backed has worked or not. Hence, even venture capital investors as fund managers typically will have a very long haul journey and long term vision of what they are backing. Hence, this whole industry is all about taking long term bets, both for founders as well as investors.
Got it. I think you rightly pointed out that क्या होता है कि मतलब जो प्रोटैगनिस्ट है, एटलीस्ट जो कंपनीज आती हैं वो प्रोटैगनिस्ट बन जाती है, एंड ऑल द लाइमलाइट गोज देयर, एंड पीपल डोंट रियलाइज कि जो इन्वेस्टर्स हैं, जो कैपिटल है, जो वो भी कहीं से कैपिटल रेज कर रहे हैं, ऑल ऑफ दैट इज पार्ट ऑफ द इकोसिस्टम, राइट, एंड दैट इज व्हाट is able to nurture the ecosystem, and that is what keeps the ecosystem running, right? I think I want to come back, Ankit, and I want to come back to your journey and the journey of the venture debt. एक हमारा previous discussion था, उसमें आपने बात करी थी कि SVB जो है ना, SVB Silicon Valley Bank, it was the grandfather of venture debt in India, right? And we all saw the SVB fiasco happening, unrolling in front of our eyes कुछ महीने पहले, ठीक? Let's start with that first. How and why do you think SVB was the grandfather of venture debt in India?
In fact, I would correct you and say that SVB was grandfather of venture debt globally. Just to add to that, and Abhinav, Silicon Valley Bank as a name has become a very popular name, but not for such good reasons for Silicon Valley Bank. Until a year back when we used to call Silicon Valley Bank, हमें समझाना पड़ता था कि what was Silicon Valley Bank, and now everybody in the country knows about Silicon Valley Bank. But Silicon Valley Bank actually started this asset class in the US. The US had the first germination of venture capital as a concept in 1970s, where most of the tech companies out of garages started in the valley in the US, right? And typically you needed investors to invest in those tech startups because they were extremely high risk but could be extremely high rewarding as well. And that's where venture capital equity as a concept started breaking out in the valley. And then there were a group of individuals who realized that if there are startups and if there is venture capital, equity capital available to these startups, but none of the banks would typically lend to these startups, because one is it has a lot more high risk and high reward. Secondly, it requires a very different mindset to understand how startups work, which typically banks don't have the focus or capability or understanding to do it. Hence, folks who started running Silicon Valley Bank, they decided that should there be a layer of debt capital to be available to startups in the valley in the US. So 1970s, where Silicon Valley Bank kind of really started, it eventually became a big bank where it started backing startups out of the US, where there were venture capital investors who were providing equity, and Silicon Valley Bank was a bank which was a bank only for startups. It was not a bank which was also doing startups. It was a bank which was created only to fund startups in the US. And they ran this business over multiple decades very successfully in the US. In early 2000s, they actually started exploring out of the US, and they started with the idea of where outside the US, if you have to go to certain geographies, we have to go to places where there is innovation economy coming up, and when there is venture capital kind of picking up, because venture debt as an asset class becomes like a derivative product of venture capital equity asset class. And outside the US, there were 4 different geographies where Silicon Valley Bank started showing interest of setting up their business. One was UK, which was essentially taking care of all of Europe. Second was, interestingly, Israel. So Israel, not many people know it, has an extremely buzzing startup ecosystem.
Yep.
It's probably the best in the world. The third was China, where China was, I think, a decade behind the US, but was growing extremely fast. And the fourth was actually India, where India, we had only seen private equity investments in 90s and 2000s, funding the Airtels of the world, but we had not really seen venture capital, right? And then in late 2000s, our current team at Alteria, our current partnership at Alteria, we got Silicon Valley Bank into India in 2007-8, where the idea was that venture capital investment has just started picking up in India. We started seeing most of the venture capital funds out of the US, they started setting shop in India, which means that next 5 to 10 years, we could see a massive rise of venture capital investments as well as startups coming out of India. And then we got Silicon Valley Bank into India as the first venture debt firm to start lending to startups in India. So of course the market was extremely small. I mean, 2008, we are talking about time where Flipkart was probably still selling books. And I was just looking to kind of becoming the Amazon of India. That's where in 2008, Silicon Valley Bank started their business in India. And hence it became like the first organization to run the venture debt business in India. And we were the first team which were running that business in India, which is currently the partnership at Alteria. And then from 2008 till 2014, Silicon Valley Bank was the first and the only unit in India run by us, which was essentially lending to startups in India. And we were extremely niche that we will only lend to startups coming out of India through the Silicon Valley Bank India Venture Debt arm. So hence it's kind of the grandfather of Indian venture debt as well as I would say a global venture debt business.
Yeah, I think before we come to what happened next, I think one of the since we are talking about SVB, I want to discuss one of the questions that have been asked the most around Silicon Valley Bank, which is what happened? Why do you think SVB collapsed? They had such brilliant, large pool of capital as well. But what happened? Why did SVB, you think, collapsed?
No, it's a interesting question, and I can tell you, over the next many coming years, there'll always be a lot of different theories that will come out of it on what really happened, and probably waiting for a Netflix movie to come out of it, because what happened was extremely academically very interesting, but it was, I would say, very unfortunate as well. Right? See, typically any lending company or an organization typically go down because the asset book doesn't do well, because probably they have done bad loans, they're not able to recover the money, and hence there is a big liquidity issue, and hence the banks go down. Whether if you look at globally, that's how lending organizations have come down significantly, right?
What about
In Silicon
leadership?
Valley Bank, or the leadership, right? But largely the reason is your asset book is not doing well. And that is typically because of probably the leadership has taken the wrong decisions on where to deploy the asset. In case of interestingly Silicon Valley Bank, their asset book actually was extremely of good quality, right? The issue was on the liability side and the treasury side, where in 2021, right, where we saw the biggest bull wave of startups, not only in India but globally. There was a lot of capital coming into the private space, which is venture capital, right? Venture capital funds started raising enormous amount of money from their own investors, and there was a lot of money sitting to be deployed, right? And because that money was not immediately being deployed, Silicon Valley Bank, being a bank, started taking all of that money from the startup ecosystem as deposits, because startups raised tons of money around 2021 in the US. Startups were sitting on $1 billion of cash. All of that money was started sitting in Silicon Valley Bank because Silicon Valley Bank started offering better deposit rates, right? And then they started kind of playing with those treasury instruments where they started putting that money into government deposits, and because of interest rates suddenly falling, they could not manage their treasury extremely well. And then essentially, because as a bank you always have the risk of what goes out in media and how kind of people perceive what is the risk in a bank, they started having some losses because of some mark to market on their deposits, and then suddenly there was a run on the bank, right? And the run on the bank could have easily been avoided if things would have been timed well and the media would have probably had been handled well. But it was just unfortunate where the bank run happened because of the loss in the value of the deposits rather than the loss in value of the assets, and hence obviously one thing led to another. And also it happens here ki whenever we are coming out of a crazy bull market, right, typically all people in the industry will find one organization to bring it down. Where, 2008 it was Lehman Brothers. Well, it's not that Lehman Brothers was the only bank which was not performing well, right? 2022 it became Silicon Valley Bank or Credit Suisse, right? Like it always becomes that one organization where everything crumbles down. So it was a very unfortunate story, especially for us, where while we were not formally part of Silicon Valley Bank, that was the genesis for VentureNet in India for us. It was those sad 2 weeks for us.
I can imagine. It was not just an emotional moment for, probably, I'm pretty sure it was an emotional moment for you guys also, but it was a very emotional moment for the entire startup ecosystem, right? बहुत सारा startup ecosystem ना में SVB was a very popular bank in the entire startup ecosystem. हो India हो US हो जो भी हो. I come from our company was part of Y Combinator, so we are very Y Combinator बहुत deep है SVB, and I think like you said, right, like you rightly said, there will be a Netflix movie, I'm pretty sure, on this. ये जो startup whole bull run था 2021 का, unseen, unheard of, and the way it
and one
collapsed.
unique part about SPV was that it was always loved by everybody in the ecosystem, right? It's tough to find so much love if you're actually either an investor or a lender. But Silicon Valley Bank always had love from all investors and founders equally at all points of time, because they were extremely
Why do you think so, Ankit? Okay.
Yeah. See, usme na, in a debt business, in a lending business, right? Because you seem to be lending money for a short period of time to a startup, where startup can go through all kind of journey, right? And as a lender, sometimes you need to react in certain situations because ultimately you think that it's your responsibility to get the money back, right? So typically a lot of times startups also avoid thinking that should I be actually taking debt, right? Should I be actually borrowing where my startup is still not profitable, right? That's where choosing the right lender is extremely important. That today you're choosing a lender who understands the startup journey very well, who is probably okay to lose part of the capital because they know that startups will go through ups and downs, right? And they belong from that space. The reason why Citibank or JP Morgans have not been able to lend to startups in the US is probably they have book of few 10 times of over than Silicon Valley Bank ever had, right? But they could never build that business because they never belonged to that space. They could never understand the startup cycle. Silicon Valley Bank always understood startup cycle in ups and downs, and they always supported the founders, right? That's how we also learned initially when we were setting up the business in India, is that it's very important that you belong to the ecosystem, right? You understand startup founder's journey, both in ups and downs, and you stay with your founders. That's how you build a very long-term business. That's how Silicon Valley Bank kind of created that name in the US, where you just kind of belong to the space and stay with your stakeholders equally.
I think that reminds me of the वो बैटमैन मूवी थी, उसमें एक एंड में एक डायलॉग आता है, राइट? यू इधर स्टे लॉन्ग इनफ टू, I'm forgetting the dialogue, right? You stay long enough to become a villain or something like that, right? But yeah, I think crazy journey. I think I want to come back to 2023 now. I want to talk about Alteria. How do you think, as we say Alteria, how do you think that happened?
Sure, yeah, काफी interesting journey रही है हमारी. Like when we our team started in India in 2007-8 under Silicon Valley Bank, right? In fact, my co-managing partner Ajay, he was CEO of Silicon Valley Bank India Venture Debt business. He in fact started Venture Debt even before that in Citibank for a couple of years, where, like I mentioned, for extremely large banks, this becomes one of the small things that they do, and the focus is not there, and hence he also moved out of Citibank to get Silicon Valley Bank into India. Right? So Silicon Valley Bank we ran quite well from 2008 till 2014, right? But एक issue इसमें आ रहा था क्या, Silicon Valley Bank, as I mentioned earlier, that outside the US they went to UK, Israel, China and India. In all the other 3 geographies outside India, they were able to get a branch banking license or do a JV with a existing bank in those geographies. Because for you to do create a lending organization, you are able to do it a lot more successfully if you really have a banking license to do it, where you can draw cheaper deposit money from the country and are able to deploy to the startups. In India, we were an NBFC wholly owned equity funded by Silicon Valley Bank, and as you can imagine, in India it's extremely tough to get any kind of banking license from RBI for such a niche business, and that too was a very small business. So in fact, we applied for banking license twice in 2009 and 10, but we were not expecting to get that. And by 2013-14, Silicon Valley Bank was not sure of their next 10 years of path in India, and that was also a time where there were 2 kind of people in 2013-14 in India, right? One were like who have seen 5 years of startups in India and did not believe that startups could be a big thing in India. And the other kind of people were, after seeing the same 5 years, were actually a lot more stronger believers of startup in the ecosystem. As you could see, 2013-14, a lot of firms exited India, but many firms entered India as well. Okay? So unfortunately, Silicon Valley Bank, they decided to exit India in 2013-14. But as a team, we were like never as excited before, where we started looking at startup ecosystem a lot more closely, and we were extremely bullish about the prospects. Like we thought if there is one asset class which could become a multi-billion-dollar asset class in India over a decade, was venture debt, because a lot more venture capital was coming up, a lot more startups were getting created, and we were the only team which was doing venture debt for the last 5 to 6 years. And that's where we helped Silicon Valley Bank to actually exit India and found 2 new buyers for the India business, which was Temasek and United Overseas Bank of Singapore. So we discovered there were 2 investors who were looking to actually create venture debt as a class in Asia, and we made that sale happen, where Temasek and UOB acquired India business of Silicon Valley Bank. And the name of that business was changed to Unraveling Capital. So the team remained the same, the entity was the same, the clients were the same, just the name changed to SVB India to Unraveling Capital, and our shareholders changed from US to Singapore investors. And the idea for the investors was, can we create a Silicon Valley Bank out of Asia, where there was no venture debt in Southeast Asia, there was venture debt being done in China, and for India we were the only team doing it. So idea was that can our team expand the venture debt asset class from India to Southeast Asia as well as China. So for next 2 years from 2014 till 16, we actually expanded this. We created and set up team in Southeast Asia as well as China, and it became a Asia level organization where Innovent Capital became had started having presence in 3 geographies in Asia then, primarily being India, and followed by Southeast Asia and China. So 2014 till 17, we were running Innovent Capital India business, where we started seeing some more players coming into India to do venture debt, but the market was getting bigger and better every year. So it was almost growing by like 40-50% for us. Like I think venture debt as an asset class had almost grown by like 10 to 15x in a matter of 7 to 8 years from the time when we started. And 2017-18 was a time where we were while we were running Innovent Capital India business, but realization also was that at some point for any fund manager's life you want to run your own fund and a lot more independently. And this is the time where the partnership at Alteria, we decided to kind of venture out and create our own firm under the brand name Alteria Capital, where even the alternative investment funds guidelines in India had opened up, and it was regulatory easier to kind of run debt funds in India, where you can actually take capital from Indian investors and invest into Indian startups. So 2017-18 where Alteria Capital was formed, where the team had experience of almost a decade running venture in India, and they had the confidence to kind of raise that capital and deploy that capital back in Indian startups with a lot more independence with us. So that was like the germination of Alteria Capital.
Got it. And Ankit, very quickly, what is venture debt?
What is venture debt? Right. So very simply speaking,
I think why I'm asking this question, Ankit, is कि मुझे ना realize होता है कि even for in a startup ecosystem ना young entrepreneurs के especially अगर बात करें तो venture debt समझते ही नहीं है लोग. Equity समझ में आता है लोगों को, debt नहीं समझ में आता. So अगर बहुत short and concise way में अगर किसी को बताना हो venture debt क्या है?
So I'll even start with taking a step back.
Yeah.
Starting ki like why is the startup founder starting up that venture, right? And what all does the founder need to kind of move ahead, right? See, when we call, we see a lot of founders creating companies in India, right, which are not even talked about and not even qualified as startups, right? Today, for example, somebody starts a trading firm which is just buying and selling furnitures by putting its own family's capital and running it profitably is also venture, right? But we don't talk about that as a startup. When we call startup, right, there is a framework, as I mentioned, about of risk and reward, right? That you're venturing into an idea which probably has not been done before, but that will only make sense if it scales extremely fast, right? And then because you're scaling it so fast, there's a risk of startup not working out, right? And for you to scale fast, right, one of the most important mode for you is capital, right? Because you're not looking at profitability for next many years, right? The only thing that you're chasing right now is creating the business model, creating the market, and scaling it, right? Then in that case, in early stages, your first backers are typically your friends and family who would essentially put equity investment into your company, which we call as angel investments, right? These are extremely small ticket size investment, which is largely to back the founder and the business idea, right? Once you move forward with that capital and you started kind of creating a product market fit, that's a time of when you spend 1 to 2 years with a startup with limited investment, is when you start talking to institutional investors that, hey, like my idea is coming to life, can I get some more capital to run this business for another 18 to 20 months? Because you have chosen a path where every 18-20 months you will continue to raise capital, because you have chosen a path of disrupting an industry and making it extremely big. And because you're not profitable, you're focusing on growth, every few years you will require capital, and the idea is in 5 to 7 years you are probably on your own or you list your company, right? Then that's where venture capital comes into the play, where your first big capital comes from venture capital equity, right? that is where venture debt also comes into the play, where to the founders, every time you are raising capital, you are diluting a part of your ownership, right? But you need capital for 18-20 months. Now the idea is you raise maximum amount of capital at your lowest dilution or lowest cost, right? That is where venture debt comes into the play, where if you raise 100 rupees of, you need 100 rupees of capital, do you need to raise all that 100 rupees as equity? Can you split that up and raise 70 of equity and 30 of debt, right? See, in the most ideal world, founder would not want to raise any equity, right? Founder would want to run the startup profitability on day one, just raise debt capital for your working capital or expansion need, and give that capital back to the lender and retain all 100% of your ownership. Because that is not practically possible because of extremely high risk associated with a startup, you need venture capital equity. But along with venture capital equity, can you have an option of taking some debt? That is a solution that venture is trying to solve. Where in early stages, venture is playing a role where it gives you a mix of debt and equity. Over a period of time, debt becomes a lot more important financing option for a company. A company is at a stage जहाँ पर आप profitable हो गए हो, you just need capital for a certain use case, then you probably don't need to raise any equity. See, today in the country, if you look at 90% of the capital being deployed to run the business is still debt, or even globally, right? Beyond a point, like when companies are self-sustainable, equity is once in a lifetime kind of a phenomenon, right? On a daily or a monthly or a yearly basis, all what you play is debt capital. To the startup, it is not possible because you're not able to service all the debt because you're not inherently massively profitable. Hence, you're actually raising equity because you don't get all of it as debt. So actually, the answer is the other way around, where debt anyways is important for any form of company, either for growth capital or financing your certain needs. But because of the very high risk associated, equity becomes a very important base to start up.
Got it. And I think I want to talk mainly about Ankit, your portfolio also. I believe that you put in capital in boat early days of boat में, right? And I don't think, मतलब अगर थोड़ा सा बात करें तो बहुत major success stories D2C brands के भी कोई निकल कर आई नहीं है. It's very early. Sorry, अभी तक नहीं. Sorry, निकल कर आई नहीं थी before boat, right? Boat was very early in that. Tell us about your interaction with boat and when you're putting venture debt into it. Why did you put capital in boat back then?
Sure. Boat, actually, I invested debt capital in boat when I was part of Innovent Capital prior to Alteria. And at that point of time, as you rightly said, there was not that big a concept of D2C brands, right? We were not clubbing these companies into these, whether you're a D2C brand or you're not, right? It was just fundamentally whether the business is making sense or not, right? And at that point of time, as you're right, we are not seeing a lot of venture capital going into consumer brands. Because when anybody would think about venture capital, right? You would think about high risk and high reward. That can you become extremely big, and you can possibly become extremely big only if there is a big technological intervention, either in terms of product or in terms of distribution. But if you look at consumer brands, right? Consumer brands may not have a technological intervention necessarily in a big way for product, or even for typically a marketplace model where you're essentially becoming a Flipkart, where you become a marketplace for buying and selling. Right? So inherently, people would think that can consumer brands become a huge opportunity? What is really the mode to get as a venture capital kind of return, right? Hence, not many investors were taking the risk of backing consumer brands, right? But around 2016-17, I think the mega shift was fundamentally, if you look at Indian consumers, right? The two things that we now started talking a lot about is affordability and aspirations, right? Today, and the third is most importantly, awareness. Today, the awareness of an Indian consumer is no different than somebody sitting in New York. We have the same data, we consume the same internet, and we have the same aspiration. But the problem in India was a little bit affordability, and second was access. Here, you want a certain high-end product, but आपको availability नहीं आपके पास, right? You probably have to go to a big city in a big mall to probably buy an imported product. Right? But what started changing in 2015-16 was because of internet. One is awareness that was changed, that everybody was accessing the same consumer brands, right? Second was because of internet distribution, everybody started having access to availability. Here today, if you know about a product, you can also get that product at home, right? Fundamentally, you don't have to probably rely on your nearest shop and only have option that the shopkeeper has, right? That was when 2015-16 when we started seeing companies like Boat, right? They had a perfect mix of in a category which seems commoditized, right? But we did not have a lot of brands in that category. Like India, say typically India as a nation, we have largely been a brand starved nation. That we've always looked at products from the point of extreme utility and cheapest in cost, right? But that started changing with better awareness, improving income levels, right, and better access and awareness. So both essentially what we really liked was it was creating a brand in a space which looked very commoditized, right, and did not really have any aspirational brand where people want to associate themselves with. Like today, for example, if I'm wearing a headphone, and I'm wearing a headphone is where I'm kind of also traveling outside. I want people to view what I'm consuming as a consumer. Right? Can I have a brand which I'm using which is aspirational, great in product, but also is affordable, right? And can that be scalable? Was the fourth big question from venture capital investment. Yes, it is scalable thanks to internet. Thanks to Amazon, thanks to Flipkart, thanks to your own website. Can you sell from 10 crores to few hundred crores in a matter of few months? The answer was yes. Because you are not relying only on offline distribution model. So 15-16 was like a great time for some of these brands where there wasn't great competition. It needed the first mover in those founders to find that opportunity of creating a affordable, aspirational, accessible brand, right, which can be extremely scalable. That's where some of those things that kind of got us extremely drawn towards Boat when we were looking at around 2018-19. And of course, like then it all comes to the founders as well. When I met the founders, it just looked like these are the founders one would want to back. Like just the energy in the founders, just how married they are to the idea, right? That was like absolutely a phenomenal back in 2017-18. And today, obviously, there's whole huge number of founders who are kind of believers in consumer brands are doing extremely well. But both were, I would say, one of the front runners, created large brand opportunities in India. And one of the things I remember that, Aman had told me, right? Like I talked about, yeah, you're selling your stuff on Amazon. Do you really call yourself as direct to consumer? Right? But his point was direct to consumer is not only about the channel of your sales. Direct to consumer truly means that are you listening to your consumer? Right? Are you listening to your consumer? Are you iterating your product? Are you iterating your design based on the feedback that you get from your consumers? That is really direct to consumer. It doesn't matter whether you're selling from your own website or you're selling from a kirana store. I think that's what truly differentiated them, where every time they would create changes in the product, both in terms of design as well as the utility, based on what consumers wanted. So I think that was truly defining moment for us as well in terms of how I started viewing consumer brand companies in India.